Hey, good morning. Today is Thursday, September the 19th. Let's talk a little bit about what the Federal Reserve did yesterday. So as I'm sure you've read or heard, the Federal Reserve cut the Fed funds rate yesterday by 0.5 percentage point, pretty large cut. And the market was certainly expecting that. If you looked at futures traders leading up to the Fed announcement, the market had priced in a 65% probability of a 0.5 point cut instead of a 0.25 point cut, which is interesting. And so it didn't really take the markets by surprise. And in fact, mortgage rates worsened on the day, which is a bit unusual. Let's do a deep dive on this so we can really understand it. So this is the history of the 30-year fixed mortgage here. And you can take you all the way back into the 90s and see when mortgage rates were over 10%. And then obviously all throughout the 2010s, mortgage rates were pretty low. And we saw this steep run up when inflation became a problem in 2022. But here lately, starting around July the 1st, we've seen a significant drop in the 30-year fixed well in advance of when the Federal Reserve cut the Fed funds rate. So we saw that because of weakening data that would indicate that the economy is past the worst of inflation and it's time for rates to settle down. And because the Fed funds rate is established 8 times per year, but mortgage-backed securities are traded each and every business day, it gives the opportunity for traders to get a little bit ahead of the Fed, which is exactly what they did. We've seen almost a full percentage point improvement in mortgage rates before the Fed did anything this past Wednesday. In fact, there's not a super strong correlation between the Fed funds rate and the 30-year fix. This is a chart of the Fed funds rate. This red line is the Fed funds rate throughout history, and this is the 30-year fixed. And while there's a little bit of an indirect relationship to it, it's certainly not in lockstep. In fact, there are many times in history where you might see the 30-year fixed increasing, though the Fed funds rate is going down, or vice versa. You might see the Fed funds rate increasing, but the 30-year fix is decreasing. So these two, while they seem like they would be directly related, are certainly not. What is more directly related is the 10-year Treasury against the 30-year fix. Those two do move in lockstep. And so if you're taking a look here at what metric you should be following, it's really the 10-year Treasury as opposed to the Fed funds rate. Let's go a little bit deeper. Okay, I'm going to move this chart out of the way and let's talk really quickly about what happened in mortgage-backed securities. So this is yesterday. This is the September the 18th when the Fed made the Fed funds rate cut, and you can see mortgage-backed securities sold off on the day. That means we actually worsened. Red days are bad days. We want green days. That means that interest rates are improving, not declining. And if you go back and look at the past 3 months, you can see we've had a lot more green on the board than we've had red. That means interest rates have been improving nicely since early July. We've gotten a nice improvement to interest rates. This particular day, though, the day that the Fed cut the Fed funds rate, we did not improve. We actually worsened. Why did we worsen? Well, let's talk about the neutral rate. So what the Fed is trying to get to here is something called the neutral rate. The neutral rate is the Fed funds rate that neither stimulates the economy nor restricts the economy. That's all they're trying to do. They don't want to stimulate the economy. They don't want to restrict the economy. They're trying to find the neutral rate so our economy grows at roughly 2% per year. That's what they're on their way to. And so what the Fed said yesterday, if you look at the language, they said, hey, the neutral rate is likely significantly higher than it was back in the 2010 to 2020 range. And if you go take a look at the Fed funds rate back in 2010 to 2020, it was somewhere near 0.25 point to 1 point, maybe 2%, somewhere in that range. And what the Fed is saying, hey, we're probably not going to cut all the way back down there. In fact, if you look at the Fed's dot plot, their projection of where the Fed funds rate will be, and this came out yesterday on September the 18th, they think by the end of the year, the Fed funds rate is going to be around 4.5%. Where is it today now? It's at 5% today. So that means another 0.5 point cut in the Fed funds rate by the end of the year. And then they project out to the end of 2025 and even 2026. And you can see nowhere in here does it show that the Fed funds rate is going down to 1% or 1.5% or 0.5%. In other words, the resetting of the expectation of what the neutral rate will be is what caused mortgage-backed securities to sell off a little bit today. It's sort of reorienting our expectation of how much our Federal Reserve is going to cut based upon their language and the dot plots. And that's why mortgage rates worsened a little bit on the day. It's counterintuitive. You would not think, hey, the Fed's going to cut the Fed funds rate and mortgage rates are actually going to worsen. They're going to go up. But that's exactly what happened yesterday. A lot because mortgage rates had already improved in anticipation of the cut. And then the Fed gave us that language that, hey, the neutral rate, the rate that's neither accommodative nor restrictive, is a little higher than you think it is. And we may not cut as much as you think we're going to cut. And that's why we saw this sort of recalibration of the mortgage-backed securities market. All told, in all candor, these dot plots that project out to the end of next year and the end of the year after that, they're not worth much, right? That's sort of an immediate reaction we're having. Really what we can focus on is what the Fed says they're going to do for the rest of 2024, which is probably another half-point cut to the Fed funds rate. Wouldn't surprise me at all to see a quarter-point cut on November the 7th, and then another quarter-point cut on December the 18th. And listen, that in and of itself is good news. The fact that we are having conversations about decreasing the Fed funds rate, that inflation is coming back down, those are all extreme positives. If I can help explain any of this any further, don't hesitate to reach out. Mark.Milam at highlandmtg.com.